In the cyber world, there's an arms race between offense and defense.
Those assets could soar to $30 trillion within a decade.
All that means that we're at an inflection point in terms of the cyber threat landscape.
Hello, I'm Bill Foster, and this is The Big Picture, where we answer the big questions facing global credit markets. Our topic today is convergence between traditional finance and digital assets. We'll discuss how new and emerging digital technologies are leading to a convergence of previously siloed areas of finance. Both new and old players are adopting the same powerful new technologies, including blockchain and advanced AI tools, such as agentic AI, to increase efficiencies and reach new markets. The result is a growing disruption of the status quo, which is quickly transforming and shifting the global financial landscape. So today we're going to focus on areas of finance where traditional boundaries are blurring from these digital forces, including private credit, emerging markets finance, and climate finance. We'll also discuss risks that come with the adoption of these new technologies, including cyber risk. So with that, I'm delighted to have Fabian Astic, Managing Director of our Digital Economy Group.
Hey, Bill, thanks for having us.
As well as Lesley Ritter, who's running our team for cyber credit risk.
Hi, Bill. Great to be here.
So let's start with you, Fabian. This is our outlook season. We're very much focused on what to expect in 2026. What are the key themes from a sector, a global perspective? So from where you sit looking into the digital economy space, what are the key big themes that you're most focused on?
I'll try to hit 3 to 4 points for AI and 3 to 4 points for digital finance, but you'll see that there's some overlap. So AI first. First, we'll keep an eye on the speed of evolution of the AI space. Everything is going very fast, and interestingly, competitive dynamics are getting more and more complex. Number two, the impact of AI across industries is more and more visible, but it's also getting increasingly uneven across industries and sectors. Number three, AI infrastructure and digital infrastructure in general is becoming the bottleneck for the space to grow. As for digital finance, probably point number one is the same as point number three for AI, which is digital infrastructure is becoming a bottleneck for the evolution of the space. You need data centers, you need power facilities, you need water facilities to support AI and blockchain platforms. And hopefully we'll get to talk about infrastructure later on in this discussion. The second point is probably regulatory developments. There's been a lot of good work globally in different regions, starting with Asia, in particular Hong Kong, Singapore, and Japan. Good work in Europe, in the EU, in the UK, in Switzerland, and some good work this year in the US with the Clarity Act. We'll track what's happening with digital cash. And then finally, there's a point on interoperability, meaning if you have your blockchain, I have my blockchain, you have your blockchain, but they don't talk to each other, and we have assets stuck on those blockchains that we can transfer, kind of defeats the point of having a global digital market. And the last point that we'll discuss that you touched on in your introduction is market convergence and how components or segments of credit markets that were previously siloed are getting kind of blurrier and blurrier and merged into each other.
Okay, Lesley, a byproduct of all this is the fact that cyber risk continues to become more and more of an issue for issuers across all sectors. What are you most focused on looking into 2026 as kind of the key themes on the cyber credit risk front?
Yeah, of course. I mean, across all the themes you mentioned, cyber risk pervades, right? But really what we're focusing on for 2026 are, one, ransomware. Once again, we've been highlighting it for many years, but it's not ending. We're seeing it now have longer term credit effects because the operational disruptions are lasting longer. The second theme, and one that probably every outlook has to talk about, and that's AI and Gen AI. And in the cyber world, there's an arms race between offense and defense, and we need to think about that in the context of our portfolio and credit. And lastly, has to do with digital infrastructure, but from the perspective of this concentration risk that we're seeing across a few vendors. More and more market participants are relying on a few large vendors, and they can potentially cause some friction. If anything happens to them, the domino effect to the broader economy would be significant.
I think it's important to take a step back and just remind our audience of how far we've come in recent years with regards to the evolution of blockchain and AI in particular. So, Fabian, can you give us a sense as to how fast has that area of the economy grown in just recent years?
Yep, I can. 2025, AI spending globally is set to hit $1.5 trillion, which is huge. But notably, efficiency of AI models has improved roughly 10 times since 2022.
Wow.
Costs are being slashed up to 80% because of that. So that's why you see more AI everywhere. And that was the point I made in my kind of outlook comments, that the speed of evolution is something that you want to keep an eye on when you see so much money invested in the AI space. On the kind of digital finance side, just look at crypto markets. Crypto market cap has increased from a little under $900 billion in 2022, again, same benchmark, to a little over $3 trillion today. But yet, the volume is and the increase is significant here. Other types of digital assets are growing too. So I'm thinking about tokenized assets, for instance. We've spent a lot of time talking about tokenized assets, what they bring to financial markets and the broader digital economy and the broader global economy, really. Those assets could soar to $30 trillion within a decade. Again, those are estimates.
That's the size of the U.S. economy. Put it in
yeah,
context.
so that, and I'm talking about the global market, and again, there are estimates that can be quite pushy by some firms out there. But nonetheless, we're talking about another magnitude that's huge, just because it's not just financial assets. We can tokenize pretty much everything out there, including real estate and art and whatnot, which explains the size. And even if you look at stable coins alone, some estimates would indicate that by 2030, that market could grow to $3, even to $4 trillion. From $1.2 trillion to $4 trillion, that's a pretty wide range for sure. But irrespective of the exact size, you're a sovereign debt expert, Bill. You can see that's a lot of U.S. treasuries and other government bonds to tokenize.
Yeah, I mean, what you just outlined is tremendous growth potential. Of course, we don't know ultimately what will happen, but certainly the trajectory is in that direction. But going back to cyber risk and the relationship here between digital assets, the nature of cyber threats has obviously changed. It's accelerated in terms of the potential threat to issuers as a result of AI. Could you provide a bit more information on that? How are you seeing the nature of cyber threats today versus just a few years ago? And what credit impact does that ultimately have on issuers?
Yeah, of course. I mean, the numbers that Fabian just referenced are pretty staggering in terms of the forecast of the growth across AI, digital bonds, blockchain. And all that means that we're at an inflection point in terms of the cyber threat landscape, right? First and foremost, because the attack surface, or the potentially exploitable attack surface, is growing exponentially. And secondly, because attackers are leveraging, and we're going to continue to leverage AI tools to supercharge the pace, the scope, and the efficiency of their attacks. So all of this is, when you hear about it in this context, is sobering and is intimidating and points to more risk. But if you don't mind, I'd just like to take a minute and think about it in the context of trends like digitization, trends of use of data and interconnectivity. All of these underpin these new technologies, and they're the feeding grounds for cyber attackers. But they're not new, and organizations have been dealing with those for many years. That means they've been building up resiliency in the system and developing controls and mitigants to address them. I don't mean to minimize the risk. Of course, investments and changes are going to have to happen to meet these new attacks, but we're not starting from the ground floor, right? We have a good base to build off of. And I think that's important to remember, because otherwise this all becomes very overwhelming very fast.
Okay, so another question I have is just, how do we pay for all this, right? I mean, you outlined these huge potential for massive growth, but so much of it relies on data centers, power, things that require real money. And the numbers are pretty astronomical when you look at the projections. So where's that money going to come from ultimately? And will that happen?
Well, in fact, that's exactly where market convergence kicks in. What we've been observing is that the digitization of everything has merged private credit and emerging markets and transition finance and digital assets into kind of a unified digital landscape and a unified credit ecosystem. In particular, let's focus on private credit for a minute, which is now I'd say $2 trillion global market. Other people would say $3 or $4 trillion. What we've seen is that with digital technologies like blockchain and AI, you can improve some inefficiencies in the credit market space. So for instance, with fractionalization, with blockchain technology, you can lower the investment tickets to get into the sector, which is needed in particular when demand and supply are not at a good equilibrium. And you can also address with smart contracts and AI a number of things like the lack of transparency and also weak secondary liquidity. So what you see is that digitalization is driving some new efficiencies in some segments of credit markets. Now, interestingly, I mentioned before that the more you digitalize things, the more you need infrastructure. The funding needs are staggering. We're talking about $65 to $70 trillion by 2040. It's just tomorrow. How is it going to be funded? Is your question. Probably the usual funding channels, which are bank loans and sovereign debt, some partnerships, won't be enough. So you'll see more and more new funding models that will merge themselves, project finance and structured finance and traditional corporate finance, transition finance, whatever, tokenization. But obviously there's a feedback loop effect here. The more things are digitalized, the more you need infrastructure. You need to finance that infrastructure. And more financing solutions are private credit or digital and tokenized solutions, which themselves need that infrastructure. So you see that perfect loop that is starting. So what I call market convergence in alignment with energy transition goals will really be a defining credit theme for the next decade, if not more.
And what does this mean for emerging markets? You mentioned transition finance or climate finance. What is the nexus there? And what should we expect in 2026 and on in terms of the impact of the new technologies in those spaces?
Yeah, so let me give you examples both for emerging markets and for transition finance. Well, transition finance first. Decarbonization, essentially, we think the funding needs are around $275 trillion by 2050. Again, a lot of money, right? Turns out that with blockchain and with smart contracts and with AI, you can make sustainability measurable and you can link its performance to financing costs. So that's number one. And we've seen some examples of that where you already see like that merger between AI and green bonds and digital bonds. Two examples come to mind. One is a digital bond that was just issued by the government of Hong Kong. Big bond, $1.5 billion roughly. The proceeds of that bond will be used to finance projects as part of Hong Kong's green bond framework. So great example of convergence. For emerging markets, I'd say they're becoming test beds for new credit models. And what we've been observing is a number of new kind of machine learning powered models with alternative data, stuff like, mobile payment histories and e-commerce records and whatnot, things that you can find online. And with those new models, you can increase financial inclusion, I would say. So we've seen across the world really, and it's true in Africa, it's true in Latin America, we've seen new platforms that have onboarded millions of users already that now have an account for the very first time in their life. And we've seen loans already for a few $1 billion provided to people that traditionally would not have had access to credit that were part of underbanked populations.
I guess shifting to emerging markets again and thinking about this increase in digitalization in emerging markets, I think we're seeing a rise in cyber attacks in emerging markets. If I'm looking at through my sovereign lens, that's the trends we're seeing. What are the challenges there for issuers in emerging markets and here with regards to the broadening of these technologies? What can they do to better defend themselves?
Yeah, firstly, you have a point, right? The attackers used to be very focused on North America, United States. Now we're seeing attacks everywhere, every continent. So it's spread, and that's driven by the fact that everything's digital, right? They have to become faster and more automated in how they apply controls and address the risk. That's number one. Number two, and something we learned from the cybersecurity survey we do every 2 years, the last one we completed was in summer 2025. And there we realized that some of the basics AI controls were not in place. For example, we found out that 30% of the roughly 2,000 respondents that completed the survey did not have any sort of AI use policy.
Mm-hmm.
We also found that, and that's probably more concerning, 22% of the respondents didn't have any kind of restrictions on the type of internal data employees can put on public AI platforms.
Mm-hmm.
So you can imagine what that could, how serious that could become if that information, that data fell in the hands of malicious actors.
Should we be worried about that?
Yes. I mean, this is some very basic blocking and tackling that could happen and should happen. Organizations writ large need to address that, because if they don't, and it falls in the hands of cyber actors, they're going to weaponize it. How are they going to weaponize it? They're going to carry out data breaches. There'll be more IP theft. There's going to be reputational damage for the organizations we rate. So yes, it's an easy fix that needs to happen. But again, technology is being adopted so fast, and responding to it is challenging. You need to move fast as well.
Especially in situations where you have limited resources and budgetary constraints, or you have to the trade-offs, right?
There are absolutely trade-offs. But again, I think I'm trying to be sober about all this. And if we think about it, if it's about implementing a policy or putting some sort of restrictions on what data can be shared, that can be addressed very fast.
Mm-hmm. Another topic I wanted to make sure to touch on with you, Fabian, is tokenization.
Mm-hmm.
So you did refer to it a few times. Why is it not taking off as much as one might anticipate, right? The adoption, implementation, it's happening, but the pace at which prior forecasts had been, forecasting, it seems to be a bit slower than anticipated. Why is it not happening as quickly as one might think?
A few things actually that we'll touch on in the outlook, and the key points I referred to earlier. The first one is that interoperability point that we talked about before. Until you can easily transfer assets from a platform to another, there are frictions that are not easy for market participants to swallow, and kind of defeats the point. The second point that I also touched on earlier is regulatory clarity. So again, a lot of progress on that front, but what we need to continue to monitor is whether we can achieve some form of global consistency. For now, we still have some real fragmentation globally. So we need to move beyond that for markets to be efficient. Again, $1 here in New York or $1 in Tokyo should be the same at any point in time at essentially no cost. And you can only do it when you have the right frameworks to make that happen globally. So that's another key kind of hurdle that is being addressed. Another one is the lack of digital cash. There's going to be soon stable coins available at scale that could play that role, and they exist already, which is a big plus for them. There will be some central bank digital currencies as well, CBDCs, at some point in the EU, for instance. It's not the case everywhere. In fact, in some regions, we've seen that progress has slowed down. The views are different globally, but there will be at least stablecoins and CBDCs coexisting at some point, and you will have tokenized deposits. So I think the next evolution of that digital finance space is to continue to show that there are things that you could not do otherwise. And then you'll get more people, you'll get scale, and then the nice virtuous cycle will just kick in.
And it sounds also like the staggering financing needs that are coming our way. We're going to have to explore every possible financing avenues, right?
Yeah, absolutely.
It's really...
Yeah, absolutely. There are risks associated with that growing interlinkages across sectors, around the world, becomes more systemic.
Yeah.
So on the cyber front, Lesley, What do you see with regards to those interlinkages? Are you worried about systemic risks? Is this a material concern moving forward, or are there enough safeguards and kind of boundaries between jurisdictions that will prevent those systemic failures from potentially happening?
Yeah, I think that's the toughest nut to crack. I mean, I think in our team, we talk about this kind of operationally, systemically important concepts. Who are the players? How do you identify them? And how secure are they, right? Because you could imagine a scenario. I mean, you can come up with all kinds of scenarios depending on what industry you're focusing on, but just imagine a situation where a large cloud provider, a large blockchain provider falls victim to a ransomware attack, right? Can't operate for a certain amount of time. Then tokenized bonds can be settled, right, across different markets, and that's a really bad day or really bad couple of days. We've seen, not in this world, but in other situations where there's been some broad digital disruptions that had serious domino effects. For the time being, they've been contained. But again, we haven't realized yet this growth that Fabian was talking about. Once this growth in these new markets happen, they have to have the proper safety mechanisms in place in order to make sure that we mitigate and minimize that risk.
Great. Well, I think that is a good note to end on for today. Thank you both very much for joining, Fabian, Lesley, and thank you at home for joining today's podcast. You can find more information on our sector and global outlooks on our website. But until next time, this is The Big Picture.
By downloading or listening to this podcast, you are agreeing to Moody's legal terms and conditions found at moodys.com/disclaimer, including that the information provided is not investment or financial advice, and that Moody's will not be liable for losses arising from your use of the information.